Jason Rzucidlo reporting from the Lear Corporation headquarters in Southfield. We're here for the 7th Annual Society of Automotive Analysts Strategic Planning Summit. Stay tuned for remarks from Mike Ward, an analyst at Soleil Securities, Norm Johnson, Director of Robert Bosch, LLC, and Ms. Kimberly Rodriguez, Principal of KPMG.
So what I'd like to do today is just talk a little bit about the industry, how Wall Street looks at it, some of the perspectives we have, why Wall Street values the auto industry a certain way. And whenever I look at the auto industry and I'm talking to investors, money managers, and you can't help but look at the industry characteristics of the industry. I mean, it is capital intensive, it is labor intensive, it is cyclical, it is low growth, and it's very competitive. These underlying characteristics have historically led to the discount that the group gets in the marketplace. Historically, GM and Ford have been valued at about a 30 to 50% relative multiple to the market, and the suppliers maybe 60, 70%. Yeah, so when I look at the industry, you look at these characteristics and you say, well, good Lord, who the hell wants to be in this industry? And I think the big thing you try to do is, they don't always stay like that. The characteristics change. And so when I look at it today, and where we are today, where we can go over the next 5 years, I look at how some of these characteristics will change and how the perception on Wall Street can change. And perhaps we get a better valuation. And so what I'd like to do is go through some of these things, just an industry outlook, what some of the financial trends are that we look at, what some of the opportunities are. The opportunities can really change some of that perception, and then finally get into the valuation of the group and how we see it. This is the U.S. sales cycle, light vehicle sales, 12-month moving total going back to the 1970s. And I think when you look at the cycle, this probably explains some of the fear with Wall Street. Wall Street likes stability, not volatility. And the group can get good valuations at the trough of the cycles. Unfortunately, they're on very low earnings. When you get to the top parts of the cycle, it's almost like everybody just anticipates the downturn, and that's when you'll see the valuations collapse. So I think when I look at the cycle today, I think something very important happened first in the 1980s, and then as you look over the last decade, what's occurred. In the 1980s, we reached saturation. We more than one vehicle registered per licensed driver. That was a game changer in my mind. So you went from an industry that was kind of growing at about 3% annually to an industry that was growing at less than 1%. After 2001, quite frankly, from 99 to 2007, we probably sold 11 million more vehicles than we should have. And I think Bob Lutz probably said it best. You know it was trouble when your monthly cable bill was more expensive than a car payment. And that's what happened. Cars, the incentives tripled between the mid-90s and earlier this decade. Cars became too cheap, and people went out and bought a third car, fourth car, and there was some lower saturation. And you can see it in some of the statistics. When you look at the vehicle population per household, vehicles per licensed driver, huge run-up earlier this decade. I think some of that has started to correct, and I think when this excess is absorbed, the industry can grow once again. And so when I look at the perception that Wall Street is looking at, we saw the excess, and it's kind of like if you go back over the last 5 years, Wall Street expected Detroit to go bad. They expected the things to go wrong. I don't think it anticipated anywhere close to the disaster that took place, but it did expect it. And some of those things I think will correct, which provides some opportunity. In the near term, you get a lot of headlines around monthly sales, and valuation of the stocks move up and down. And I think there are some people that say the stocks will move when we start seeing selling rates above 12 million units. When I look at the U.S. market, we are not an 11 million unit market. We are at recessionary levels. Normal demand of 14 to 16 million units will come back. Americans are not going to stop driving. There are people, one of the big negatives you hear in the bear case on Wall Street is that people are going to go to one car instead of two. And I would say, oh, you're going to share a car with your spouse? It's not going to happen. Americans are going to continue to drive. You're going to have more than one vehicle registered per licensed driver. So in the near term, yes, we're still absorbing some of that excess that we had. Sales seems to be stuck in this rut of about 1 million units a month. I don't see any reason why that won't continue, at least in the near term when we have some uncertainty. But it's all about comparisons. But in the meantime, we are heading in the right direction. And you look at the chart on the left and just see the SAR rates continuing just kind of improve gradually. Longer term, I think that it's very bullish. The underlying demographics of the industry are probably as positive as they've been, at least to the 1994, the 1980 cycle. The vehicle population is older than it's ever been. This is data from RL Polk, and if any of you, most of you probably know RL Polk, but Wall Street, they're just starting to get more and more educated about the data that Polk provides, and their data is outstanding. You know, this chart here, when I look at replacement demand or scrappage, I break it in two. The vehicle fleet right now, the average, according to Polk, is over 10 years of age. And you've had a tripling in the vehicle population, you know, since 1980, of the vehicles over the age of 10. Vehicles over the age of 10 disappear or are scrapped at about 4 times the rate of the vehicles under 10. The old fleet will need to be replaced. We're going to replace those vehicles. Now, the scrappage rate has declined materially, you know, since the 1980s. But, you know, on average, it's been about 11%, and it's gone down to about 8%. And that's the quality improvements and the other things, the expense, and everything else that's come into the vehicles, which is certainly positive. But it's not like they're not going to disappear. If you have a vehicle that's 15 years old and it's got 150 or 200,000 miles on it, if it needs new tires, you're going to junk it. And so you're going to replace vehicles at an increasing rate. So when I look at the industry over the next 5 years, I start first and I say the population over 10 is going to provide almost 10 million units of new demand pretty consistently over the next 5 years. Now, the under 10, when people argue that cars last longer, they don't disappear as much, you look at the disappearance rate under 10. It's been dead flat, right at about 3%. And despite all the quality improvements and everything else, most Americans can't drive. Most Americans don't take care of their cars. So you do get scrappage of vehicles under the age of 10 for whatever reason. Either way, you know, it still is going to result in somewhere replacement demand of those vehicles of about 4 to 5 million units annually. I was always taught that when a car is junked or scrapped, the owner has 3 choices. You buy a new one, you buy a used one, or you start walking. Americans don't walk. We don't ride bikes either. You know, we drive. That's what we do. And so I think when I look at the industry, normal demand of 14 to 16 million units is very plausible. We do have a shrinking fleet, and I think when the Polk numbers come out again, we're going to see the fleet drop sharply in the period ending June 2010. But I think when you look at the underlying demographics, the need to replace those vehicles, the increase in the licensed drivers, and you know, the people that are turning 16 and getting a license to drive in 2015 were born 15 years ago. We know who they are. We know where they are. They're going to get a license to drive, and they're going to get a vehicle. So you have growth coming back into the market with replacement kicking in. So when I look at it, you know, the bottom line is the outlook is very positive for Detroit from a vehicle sales standpoint. So even though we're sitting here in this market that's 10 million units, 11 million units, it's going higher over the next 5 years. And I think, so when I look at the perception of the industry and how it's valued, it's not necessarily a low growth industry. Going from 11 to 15 million units over the next 5 years is a very positive attribute. And it should be reflected in stock valuations at some point. You know, in the near term, economic variables definitely influence valuation. And, you know, we see a lot of them. And this is just a dozen or so that I kind of track to see what some of the near-term trends are in demand. The thing that stands out to me is that most of the direct consumer economic variables, whether it's confidence, income, housing prices, are all negative. I mean, they seem to have bottomed out, but they're still negative. I don't think consumers feel very good. They feel like rushing out to buy a car tomorrow. And now you put in all the uncertainty with Washington and what's going on with the tax situation, it has certainly caused some concern. But I think, you know, the bottom line in my mind, when I look at the industry and trying to assess some sort of Wall Street valuation on these stocks, we're in a sweet spot. We have an ideal operating environment set up for the industry over the next 5 years. I kind of, we're going to get this modest but steady recovery in industry demand. You know, we may not see the normal demand levels of 14 to 16 million units for a couple of years, but there's nothing wrong with 12.5 or 13 million units if the industry is, if its cost structure is positioned properly. You know, we've already proven that we can make money in the industry at 11 million units. So if we start getting up to a U.S. cycle of 14 to 16 million units, I think it'll be very positive. And again, I think that stability, you know, will certainly help the valuations rather than the big cyclicality or the perceived cyclicality that the industry could have going forward. These are just some of the positive negatives that I've kind of looked at. When I add all these up, the implications of a modest and steady recovery, Detroit's going to be a great place to be over the next 5 years. When I come out to Detroit, whatever number of times each year, last year when I came out here, it was like a ghost town, and everybody kind of looked like they were walking dead.